All right, Jesus says, hello, Michael. Is there a way to determine the best risk-reward bullish put vertical spreads on stocks that have dropped in price after earnings like Amazon, Zen, and Pins? Okay, Jesus, I don't have a kind of calculator. I wish it's an idea that I'm flirting with and talking with the programmers about from time to time when I have time between other projects. I'd like to do something like the long option finder we looked at a little while ago to seeing which put would give us the best bang for the buck with a bull put credit spread based on which debit or credit spread would give you the best bang for the buck if the stock moved up 2% or 3% in a 1 or 2 week time frame. The best way to evaluate the risk reward on vertical spreads is to use one of 3 tools. The simplest one, but not simple, Jesus, for the stocks that you're talking about, would be the search by symbol. I can just go into search by symbol and say, okay, AMZN, and I want to look for some expirations that are weeklies, for example. I want to look at more results. Oh, that's ridiculous. Not only is it ridiculous showing me 0 days, but you can see it. This is not the tool you want to use. This is a great tool for me to use if I'm thinking about doing bull put spreads on, what was that other stock I was considering about today? RCII, for example, and I don't even think they offer weekly, so I might not get any results yet. But let me just go to a set August expiration. See, now this isn't bad. It only offers 5-point strike differences. I can see right away what is my potential return with probability. Right away, my eyes are going right to here. Right? I don't do 60% probability credit spreads. I don't do 70. I go to 80, 85% or higher. So I know right here I'm in this range, and I guess my eyes would gravitate right to this one. It would be the 50, 45. This is not a trade to do a bull put credit spread on, I'm sorry. I chose this one because I was looking at it as a married put because it has earnings coming up as 8-4 as we saw at the beginning presentation. Do not do a bull put credit spread, bear call credit spread, or debit spread on RCII because earnings are coming up on the 4th of August. But things like Apple, Amazon, there's too many strikes. There's too many expirations, okay? Doesn't do what you want. So it gives me what we're talking about, the return versus probability, but it's everywhere. There's too much to go through here, Jesus. I agree with you. On the larger price stocks, do not use this tool. Use the spread chain. And I would go to put credit and call debit parity view. And I'm going to put in Amazon. And the great thing about this tool is I could put in 5 basic criteria. What do I want for strike differences? Let's just use 5. What do I want for a minimum net credit? Yeah, let's say 15 cents. Out of the money, 3%, that sounds fantastic. Minimum return, I want 10. And probability, yeah, greater than 80%. And let's go 7 days out. Nothing. Nothing's at least 3% out of the money for next week with a 10% return and 80% probability, 5-point strike difference. Are they 10 points? I'm so sorry. Okay, so now this one here gives me a combination of probability versus return. But again, I'm going to go back to 10% return where I wanted to. Now I got my strikes correct. There we go. And so 7 days out in time, I'm in some good range. So I want a 15.3% return with an 83.5% probability. Okay. And 19.8, I'm sorry, here this side here is the bull put side. And this side here is the call debit parity. I'll explain that in a moment. But this allows you to look for the positions you want with at least some basic ranges of a good return that you want. Start your starting point. Hey, do I want to compare a 0.7% return with a 99% probability? No, I want 10%, I want 12%, I want 15%. If I'm going to go up to 20% return, what do I know I have to do? Not 120. If I want to go up to a 20% return, Jesus, what do I have to do? I have to adjust my probability. It's not going to be 80%. I'm going to have to go to 75. Okay, so let me take a look at those. All right, none match there. Wow. That's probably because I have to go to 70. Oof. For 1 week out. Nothing. All right, so I'm showing you this 1 week. Okay, so going 1 week out, what did I have to give up? I can't go as far out of the money to get the net credit and the return that I want. Even with a 70%, probably 3% of the money, you're not getting that return with 1 week out. Well, we are with 2 weeks out. When I go back up to 3% out of the money, We've got a 26% return with a 75% probability at 32.10, 32.20, bull put spread. Okay, so 33.27. And again, our strikes here are 3,200 for the sell. Yeah, I'm 32.20 for the sell, 32.10 for the buy. Here's a little bit further out of the money. Lower return, 23.9 with a 77.5% probability. This is 2 weeks out, remember. And a 20.9% return with a 79% probability. But again, I couldn't go 3% out of the money and get that 20% return 7 days out. So, how is this helping you determine the best risk reward? Because you don't want to take too much risk and go into the 63, 65% probability, Jesus, hoping for a 30% return. And you might not even find that in the 7 days out to expiration cycle. Going 14 days out usually seems to be a good cycle that we target. And as we talked about with Fernando a little while ago on the buying of the puts, why we like to buy further out in time to have the lower cost per day and a lower annualized cost. When I'm selling, I want to be selling shorter term if possible, but I got to have my probability, the range out of the money I'm comfortable with, and the return that I want. Again, my probability is a minimum of 3% out of the money, usually an 85% probability, and usually I'm targeting a 12% return. So whether that's 7 days out, in this case, none. 14 days out, kind of like it. 5.3% out of the money, and 5% out of the money, 86%, 3160, 3150 for a net credit of 120. Of course, then I can now go, Jesus, I know these ones that match. As I go further out in time, I add in the next cycle. That's rare. Usually you expect to see more as you go further out in time. That's very interesting. I'm not seeing that many further out in time in that case. I wonder if the strike price changes, that they're 20 or 15 instead of 10. Let me try that one. Very, very interesting. Is that telling me something else I should be aware of other than the strike differences? Let me try 20 and see what we get. No, just the 14 days and 21 days. What do I mean by something else I should be seeing? Well, it seems that 14-day out is a really good premium generator for Amazon. Okay, it just came out today, and that's what you're talking about. It had the big drop today, and you're expecting a bullish recovery. Bid-ask spreads might be too wide in that case, Jesus. But this, I think, is the tool that you want to use. But it does take some work because, as I've failed you in the first start of this discussion, I was looking for 5-point spreads on Amazon that don't exist. What about PINS? Okay, and nothing. Okay, pins. Yeah, let's go to the option chain for pins. No, it has weeklies, and they're 1-point strike differences and 2 points. 2 should have worked, or 250 should have worked. That is some weird strikes. Good. Single strikes. Oh, and then occasionally there's a 50-cent strike. That's so weird. Okay. It's not consistent is the issue. Bid-ask spreads aren't as bad as I thought they were, but yeah, there's not a lot of premium here on these puts. You're probably going to have to go further out in time. So that's a 70-cent premium on a 5-point spread, but there's nowhere near the probability I want. This is too close to at the money, and here's only a 10-cent net credit on a 5-point spread. That's not giving me the return. That's why they didn't pop up, Jesus. That return 14 days out doesn't meet my goals. Let's go to standard. That's not standard. I'm sorry, August 20th. Let's get to a large chain here. Let's go to puts. Yeah, so this is the one thing you have to do. You have to know the stocks and know the expiration cycles. So this one should have worked. 20-cent net credit, 23-cent net credit on a 5-point spread. It doesn't have the return. It has the probability. It doesn't have the return. That's the problem. So it's a trade-off. So that's good. Why do I mean that's good? If my goal, and I'm using 5-point spreads, and I want to get at least, okay, we're going to say a 10-cent net credit. Yeah, I want to be 2 or 3% out of the money. I want that 10% return and that 85% probability. I'm going to take these other expirations out, and we're going to go standard. It's still not making it. And so let's go down to 80. Everything should be there. Oh, percent out of the money range should have been fine. Okay. That's very odd. Must not be a 10% return. It wasn't. It was only a 4.8% return. My apologies. So that's tough. What does this tell me? This does tell me this is probably the only bull put I would enter, but it's nowhere near my requirements. Rather than trying to pick a stock that's fallen, Jesus, after earnings, I think it's going to bounce back up. Personally, I'm just going to use my bull put search in that case. But I suggest using the spread chain tool. And if you see no results, as I just sort of waffled through here, Zeus, that tells you that nothing's going to match the criteria you want to make that trade worth your while. Just because it's bounced down, you think it's going to come back up. Those probably aren't going to be worth your while. Yeah, I'm going to be looking in this range, 20, 14, 14.3. 85% probabilities are higher, 3 to 7% out of the money. Our default bull put weekly, 2 weeks out of time. That's what I'd probably stick with in that case. You don't see those ones in there because the default criteria we're looking for. Again, play around with that spread chain. Put in your basic criteria, know your expiration dates. Again, if I was trying to do something on RCII or Campbell's or something of that nature, I would have to take it to the standard August 20th because they don't offer weeklies in that case. So you want to know, of course, what the expiration time frame is, and you want to know what expiration dates are offered, Jesus. My apologies. And know the strike differences to help. But this tool, I think, will get you to the point where you can go through the different expirations and say, give me any of the ones and any of the near-term expirations. So remember, you don't want to do a 6-month out bull put spread. All right, you want to keep shorter term, 7, 14, 21, 28 days standard expiration. Go through it and say, okay, hey, I want 80% probability. I want 2% out of the money. I want a minimum 7, 10% return probably. Minimum 10% return, I should say. And then the spread width you might have to toggle because your stocks are different prices. Some were only 10 strikes, some were 1 strikes, some were 1s and then 150. And that got weird. But again, you should be able to find what you want. And then I can say, okay, well, the 7th is offering me this return with an annualized return, showing you the annualized return. So you can compare that here with X probability, but 2 weeks out, I have this, 3 weeks out, I have this. And you can just compare the different expirations to sort of see which one gives you what you feel is the best bang for the buck. Now, I'm going to go back real quick. Let's go back to Amazon. Change my numbers again, okay? I'm going to stick with, of course, 10. And we're going to stick with 15. 3% I think was going well for us, and 10% return, 80% probability. Okay, I want to explain this real quick, and we've jumped off a little bit. Okay, and sorry, what are we looking? What is this parity view? Okay, well, this is the bull put. So this one here for Amazon, 21 days standard expiration. I'd be selling the 31.50 with Amazon at 33.27 and buying the 31.40 put. Midpoint net credit is $1.50, which gives me a 17.6% return and an 82.6% probability assigned. What is this over here? This is the same trade done as a bull call debit spread. In other words, we're selling the 31.50 call that is slightly in the money and buying the 31.40 call, which is slightly in the money. The debit on this 10-point spread is 808. So if I get the 10 points back, if the stock stays above those strike prices, and I can get the midpoint of 808, that means I'm going to have a profit of 192 for an 808 investment, or 23.8% return. As opposed to a $1.50 net credit expiring worthless and a 17.6. They have the same probability because they're the same short strike price. This is the parity trade view. When I see this, I may be tempted to give it a go to get as close to this midpoint as possible on this bull call debit spread, because I'll be getting a higher return than the bull put credit spread with the same probability make the max profit as long as it's above 31.50. It's just 23.8% versus 17.6. And I'd have a lower loss. If I lose everything, I'd be down 808 as opposed to on the 10-point spread, 850. Do you always see that? Is the bull call debit spread always higher? No, in fact, at the next strikes, it's lower. The parity is actually lower than the bull put credit spread. So if these were the strikes I wanted and the return I want, I'd be staying with the bull put credit spread. Trick is, why is this difficult? Is because in the money calls usually have a wider bid-ask spread. The in the money bull call debit spread, individual options usually have a wider bid-ask spread than the out of the money puts. So there's not as high of a chance you'll get filled at these midpoint prices to get that 808 cent mid-ask price. But it's worth looking into if you're increasing the return, in this case, almost by 30%, right? We're increasing it by 6.2% from 17.6 to 23.8. That's about 33%, isn't it? About a third of it. It's a third higher. So that's worth it. If I could get filled at that midpoint and on the same expectation of a stock being up in price, the parity bull call debit versus the bull put credit spread, I might make it a go. But if this were the strikes that I wanted, 31.50 to 31.60, 18.6 on the bull put, 13.6 on the bull call, yeah, I'm right here. I'm staying with the bull put credit spread, not even looking at the bull call. I just wanted to remind everyone, of course, that today's material are my thoughts on your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct recommendations or direct trading suggestions. Options do involve risk and may not be suitable for all investors. If you like some of the tools that you saw today, we got to see a few good ones. We looked at the spread chain tool. We went through a little bit of the portfolio in the earlier slide presentation in regards to analyzing the liquidation value. We looked at a couple of the searches. We looked at the search by symbol, but to show that on some of these larger price stocks, that's not necessarily the tool you want to use to find the credit spreads, as there may be too many. But a lot of set of great tools you saw today. You can take advantage of them for free for 14 days. All you need is a name and email address. Just go to powerop.com, put in your information, hit start my trial, no credit card information required. You have full access to the tools for 14 days. After that, the subscriptions only start at at $45 per month. And of course, they go up that's for the end of day service. The delayed service, you have access to all the tools, search capability, portfolio, but with delayed quotes, that's only $65 per month. And of course, we do offer a real-time service and others as well. Now, of course, we talked a little bit about some of the previous webinars, the recent webinars we've posted. And again, this was recorded. We'll get these posted soon. But at any time, you can go to our archived webinars page and scroll through those, or you can go directly to the Power Options YouTube. You can look into the videos and you can search the videos for questions such as collars, earnings, long calls, long puts. We try to title and tag all of the webinars we do with the proper strategy name. And you can go through some of our listings of our other education, free education that's there for you. Now, if you do think of any other questions at any time, just remember, send me an email to support@powerop.com or support@radioactivetrading.com. Of course, you can also call us during market hours at 302-992-7971. And of course, trial members and subscribers, you can schedule a coaching session at any time. It's essentially a 35 to 45-minute phone conversation with myself or Ernie. We will walk you through the tools on the site and answer any questions you might have. Kind of what we do today, but more on a one-on-one basis. And we can design the coaching session to go through a go-to-meeting, go-to-webinar format like we saw today, or normally we just do it over the phone. But if you want to request it, when you fill out the note for the coaching session, just tell us, yeah, I'd like to do it via webinar or via go-to-meeting, and we'll get that set up for you as well.